Is a complex strategy a form of avoiding responsibility? At first glance, complexity in investing appears sophisticated. More indicators, more models, more macro inputs, more moving parts. It feels professional. But an uncomfortable question emerges. Is complexity sometimes a psychological shield, a way to avoid responsibility? Let's examine this through behavioral finance, psychology, and decision theory. 1. Complexity can blur accountability. Simple strategy. I buy diversified index funds and hold long term. If it fails, the outcome is clear and measurable. Complex strategy. 14 indicators, sector rotation, macro overlays, tactical hedging, dynamic leverage. If it fails, responsibility becomes diffuse. The model parameters need adjustment. Volatility regime changed. It was an exogenous shock. Complexity creates interpretive flexibility. Psychologically, this protects the ego. 2. Self-serving bias and narrative protection. Research by Daniel Kahneman shows that humans naturally construct narratives to protect their self-image. With simple strategies, outcomes are transparent. Skill versus luck is easier to evaluate. With complex strategies, it's easier to explain away underperformance. Attribution becomes subjective. Complexity can act as a narrative buffer. 3. Overfitting creates illusion of control. In statistics and machine learning, overfitting occurs when a model is too tailored to past data and performs poorly in new environments. In investing, complexity often leads to backtests with many parameters, optimized entry/exit rules, regime-specific tweaks. Each added variable increases the illusion of precision. But precision is not the same as robustness. Complex systems often feel safer because they appear more informed, even if they are more fragile. 4. Decision diffusion. When a strategy has many layers, signals conflict. Risk filters override each other. Discretion overrides rules. This diffuses responsibility internally. Instead of, I made a wrong call, it becomes, the signal stack aligned incorrectly. Language changes. Ownership softens. 5. The status incentive. In professional finance, complexity signals intelligence. An active manager explaining a simple index approach sounds unimpressive. But a multi-factor, macro-aware, volatility-adjusted, cross-asset tactical model sounds sophisticated. Complexity can function as a credibility signal, a career defense mechanism, a justification structure. Sometimes complexity exists not for performance, but for explanation. 6. Simplicity exposes skill. Consider the philosophy of John C. Bogle, founder of the Vanguard Group. His argument was radical in its simplicity. Own the market. Minimize costs. Stay invested. This removes tactical excuses, timing narratives, structural complexity. It forces accountability. Either you stay disciplined or you don't. Simplicity makes behavior visible. 7. However, complexity is not always avoidance. Important distinction. Some strategies require complexity because markets are multidimensional. Risk management can require layered hedging. Institutional constraints demand structure. Complexity becomes avoidance only when it obscures decision ownership. It protects ego more than capital. It makes evaluation impossible. The issue is not complexity itself. It is unnecessary complexity. Psychological pattern. When performance suffers, investors often respond by adding indicators, adding filters, adding tactical overlays, increasing rules, instead of improving discipline, controlling costs, extending time horizon. Complexity becomes a reaction to discomfort. The core question. Ask yourself, can I clearly explain my strategy in 2 to 3 sentences? Do I know exactly why each rule exists? If it underperforms, can I accept responsibility? Would removing layers change performance materially? If the answer is unclear, complexity may be serving emotion, not logic. Conclusion. Complex strategy is not automatically avoidance. But complexity can diffuse accountability, protect ego, Create illusion of control. Mask weak conviction. Simplicity is psychologically harder, because when the strategy is simple, the only variable left is you.